Hi, and welcome to Macro Matters. My name is Stephanie Kelly, and together with my co-host Paul Diggle, we'll be guiding you through the world of economics, politics, and markets. This week marks the rather grim milestone of a year since the World Health Organization declared the COVID-19 spread a global pandemic. But a year later, we are just about starting to see the light at the end of the tunnel, with vaccines being rolled out in major markets, and we're starting to see some early signs of lockdown easing. So ahead of this easing, I asked our Macro Matters team what they are going to do when lockdown lifts.
For me, it would be a meal and a movie with my wife. Something we used to do a lot of, and just getting out and enjoying that big screen experience and someone else cooking the dinner.
So after lockdown, I'm definitely looking forward to actually putting on a pair of jeans. I cannot remember the last time that I've actually taken off the sweatpants. So really looking forward to dressing up, putting on some makeup and just going out for dinner. Yeah, and just having somebody else wait on me and not having to do the dishes. So yeah, looking forward to that.
Yeah, I'm so looking forward to playing football again and coaching, and also just being part of a crowd and getting back into a football stadium on a Saturday afternoon. I'm so looking forward to that.
When lockdown ends, I'm looking forward to going to the weddings of various friends which have been repeatedly cancelled and rescheduled over the past year, and having a good old party with loads of other people.
So there you heard the voices behind this podcast on what they're going to do when lockdown lifts. But the big question is more generally for investors, for policymakers, when lockdown is over, what will people do with their hard-earned savings, with the income that they have? And what will all of that mean for growth, inflation, and market returns? To help me tease out some of these answers, I'm delighted to be joined by James McCann, our senior global economist at the ASI Research Institute and a regular guest on this podcast. Thanks so much for joining, James.
Thank you for having me.
So, James, I thought maybe we could start off just by talking about what has happened during lockdown in terms of people's behaviours relative to pre-crisis. So how have spending patterns shifted in developed markets, particularly the US, that's where you're based, of course. How has that shifted during lockdown compared to what we saw pre-crisis?
Well, as we just have been saying consistently through the course of this COVID shock, it's been just really an unusual crisis. And the first point to probably raise is the nature and the depth of the initial shock. If we cast our minds back 12 months ago, we were obviously just about to, depending on where we were in the global economy, in some form of lockdown. And what that really delivered was a really extraordinarily deep hit to consumer spending. So if we think in the US, the Q2, which captures most of the period during which the economy was locked down, we're talking about a 10% year-on-year decline in overall consumer spending. Now, to put that in context, during the Great Recession after the financial crisis, 2008, 2009, we saw spending in year-on-year terms bottom at around 2.5% down in annual terms. So it just gives a sense that the initial shock to spending was extremely large, and that meant that the recession felt quite different. I guess that shock was relatively short-lived, and as you started to see the crisis, or not the crisis necessarily, but as you started to see restrictions on activity start to ease as we began to get over that first wave, then spending came back relatively quickly. It didn't come back all the way, but it came back relatively quickly. And then I think the other interesting component is the nature of that spending shock. So again, if we take the 2008-2009 financial crisis and think about it, it's really, really clear that back then people thought, right, now's a really bad time to spend on sort of big ticket items like durable goods, things like cars, new furniture, TVs, consumer electronics, etc. You know, as risk aversion started to rise, they decided they didn't want to go out and spend on those bigger ticket purchases. During this crisis, I think what's been really unusual is that dynamic has almost flipped. The nature of the restrictions on activity, be it through lockdowns, be it through limits on restaurant capacity, closed sports venues, etc., means that a lot of the shock has really come on the services sector. And that's where we've really seen the biggest decline in consumer spending. Whereas actually those durable good items that were really unpopular during the previous recession have been really popular. And that's just a dynamic of people couldn't spend their money in the ways that they usually would have done. So they diverted some of it towards those durable goods.
I guess that's the interesting thing about this crisis. I guess it's a health crisis, right? It's not just an economic crisis, but it's actually like we can't go out and spend in the way that we might want to in another world, in a quote unquote normal recession or a normal crisis. So I guess that compositional shift is quite profound.
Yeah, it absolutely. It's really extraordinary. And it's an interesting dynamic. So you've probably got two things going on within it. One is that shift as people can't go out to restaurants and bars, go to museums, travel overseas or domestically, stay in hotels, a whole bunch of services spending that just isn't available to them, or they're not willing to take the risks that would be associated with doing that. They've invested in stuff like doing up parts of the house, buying garden furniture because they're there more.
Because we're stuck inside.
An interesting dynamic that some of those, exactly, some of that firepower was transferred within spending. But obviously, as I mentioned before, there was still a really big drop in aggregate spending, which tells us that some of that was just a forced saving. So it's natural that savings would rise as you go through a shock, as people become concerned around their long-term income, their employment prospects, they become more cautious. But the degree of the increase in saving during this crisis, with the US personal savings rate rising to over 30%, probably tells us that people just physically weren't able to buy more stuff. Instead of going out and spending money on services, there's only so many TVs they wanted or so many patio sets that they wanted. They're actually what we think of, they actually delivered a degree of forced saving where they physically couldn't go out and spend in the economy. So that accrued in their savings account, in their checking accounts. And that's something we're seeing very clearly now. If we look at US household checking accounts, there's an extra around $700 billion sitting there pretty much dormant, which we think is almost like trapped savings to some extent.
I think that's really interesting, James. And we'll definitely get into the question marks that raises about how people behave once lockdowns lift and economies do reopen. But one thing I wanted to kind of ask about is the distributional element of the trends you've just talked about. So when it comes to spending and saving, how different are things for wealthier households versus, poorer households?
Absolutely. I think this is the really, really critical thing to emphasize. When we look at household balance sheets from an aggregate top-down perspective, they look pretty healthy. They look great. Household net worth has increased through this crisis, which is really unusual from a historical perspective. But I don't think it takes too long when we dig a little deeper to see that certainly some of the households on the lower end of the income distribution have not necessarily had such a positive experience through the crisis. And I think that reflects predominantly where this crisis has struck. We know that it's been more common that lower income workers, particularly in the services sector, which is most sensitive to COVID restrictions, to lockdown restrictions, think about hospitality, leisure, accommodation, etc. These are all sectors that we know from the labour market data, which have really struggled over the last 12 months. And those lower income households who work and depend on those sectors have certainly had a more difficult time of it. If you compare that to many high income individuals or higher income individuals, they've been able to do things like work remotely. There's been fewer disruptions to their income through that period. So, absolutely, I think even there's an argument that you've seen this case style recovery within the household sector, even where some of the better off, or at least middle to high income households, have seen fewer disruptions. They've been able to build up savings. They've benefited from some of the tax and stimulus measures put in place by successive governments, whereas the low income households, while they've also benefited from those stimulus measures, they've not really gone through the crisis unscathed from a labour market perspective, and they're the ones feeling a little bit more stressed. So I think it's so important to highlight that, even though in aggregate the figures look pretty good for households, there's definitely a lot of disparity between how those balance sheets have evolved through this crisis. And that'll matter a lot when we think about how that money gets spent as we go forward too.
Right. Particularly, I think you made the point really well that there are just some kinds of activities that lower income households are just more exposed to because of the nature of the kind of work that gets done. I guess you mentioned there as well the fiscal stimulus element and the role that has played in terms of providing support. But I guess what's interesting is if you compare the US to kind of Western European countries, there is a bit of a differentiation in terms of how the labour market was supported. So in terms of kind of furlough schemes were much more common, or short work schemes were more common in Europe. And in the US, it seemed to be more kind of, checks based and unemployment insurance based. Do you think that makes a difference, the kind of policy support and the kind of, I guess, the extent to which people remain attached to the labour force during this crisis? Do you think that matters?
Yeah, I think it's important as well. Absolutely. I mean, it's very clear from, if we take Western Europe versus the United States and just look at what happened in the labour market, the degree of shakeout that you suffered in the US over March, April, May was pretty significant. We saw, really quite aggressive cutbacks there. Now, some of that has come back, and I think there's been one or two policy schemes which have helped that. The Paycheck Protection Plan provides grants for businesses and strong incentives within those grants to hire back their workers. So they've helped to some extent. But you're absolutely right that more of the release valve has come through people being fired or put on temporary leave, for instance. And that has a bigger potential long-term effect. It does risk that there's more permanent job losses through this crisis. Again, if we look at the split of US permanent to temporary layoffs, then there's still a very significant amount of permanent job losses showing up. And from a household perspective, it just creates a greater degree, I guess, of financial anxiety too. Those furlough schemes or short hours schemes at least allow people to stay in employment, provided them with a degree of income. And employment insurance, in some cases, more than made up for that. But obviously that paused as we moved into the second half of last year before the stimulus plan, and that I think proved to be very quickly quite financially painful for quite large portions. Certainly, we saw quite quickly US consumer spending fall noticeably as some of that support gave way. So. Yeah, I would tend to agree. The US tools have been a little bit blunter, perhaps a little bit less well targeted, and I think to some extent that might have exacerbated some of these underlying trends.
Right. I think that's a really interesting kind of comparison. I guess there are question marks that will come through then in terms of that labour market flexibility, whether there are benefits during the recovery phase in terms of how companies behave versus their Western European counterparts. So maybe let's move on to that, which is what happens next, given how big an impact that COVID has had on spending and on saving. What are you expecting to happen in the next few months as things reopen? And particularly, I guess, maybe let's start with the spending side. Of course, spending and saving are linked, but how are you expecting behaviour to change, maybe compositionally, but also just in terms of people's willingness to go outside and spend money and engage with the economy? What do you think that means for the growth environment?
So I think as the recovery starts to proceed, particularly helped by the degree of fiscal support that we've spoken about a number of times on these podcasts, but also by a vaccine rollout and the potential relaxation of COVID restrictions that puts in place, I think we should expect a couple of forces to kick in. First, certainly that fiscal support is providing even more help to household balance sheets, and maybe a little bit more targeted towards the lower end of the income distribution. So a larger round of stimulus checks, enhanced unemployment insurance support, child tax credit, for instance. These are all things that should help across the income distribution, but particularly at the lower end. So I think you've got a position in which households at least should see some boost to their personal income perspective. And then the second point is, as you mentioned, there may be more avenues for them to go out and spend. So this concept of trapped saving, whereby people just physically can't go and spend on the types of activities, experiences, services that they normally would do. If we're right that the vaccine rollout is enabling some of the restrictions on those activities to ease, then that trapped spending should moderate. So as we go forward, we think that month to month households can probably can probably spend more of their personal income on goods and services in the US economy. I think more of the focus, we might see a little bit of a reversal in that shift towards goods that I mentioned at the start of the podcast, and back towards services as you start to see the economy reopen and people shift back into their more normal consumption patterns. And I think consumption through that period in aggregate can be very strong. So when we look at our Q2 growth forecast, we're really penciling in a pretty powerful 10% plus annualized increase in overall US growth as you get really a very robust reacceleration in the economy based on people being able more to go out and spend, first of all, and secondly, them getting another leg up from the fiscal support coming through. So we think these two things interact to mean that you should have a really powerful consumer impulse over the next few months and maybe even the next few quarters.
So I think that's really interesting and makes sense, right? I mean, as we heard on the initial clip, and as lots of people feel, you're just getting to go out and do the things we used to do and see people in a setting in which we are still consuming services like restaurants, bars, whatever. I think it makes sense to think that as things start to open up, people might feel more open to doing those things. Maybe one interesting question is, what lessons might we have learned in the last summer? Lots of things were quite open. We saw reopening across a number of Western economies, the US included. Was that the kind of thing that we saw after the initial lockdowns? Did we see that big boost to spending? And I guess, is there any reason why, given you mentioned vaccine rollout, is there an expectation that it'll be different this time because of the vaccine? That is this time genuinely different versus last summer?
I think last summer can give us some clues, but I think this time will be a little bit different. So absolutely, as the economy started to reopen in the sort of late spring into the summer last year, we certainly did see some of the hit to services spending start to moderate, and that was as bars and restaurants were able to reopen either for takeout service or for limited seating, outdoor dining, etc. We saw a little more than half of the hit in overall services spending come back relatively quickly, but crucially that remained still well down from where it was at the start of last year before this crisis struck. So what I would imagine would be we would see an even more powerful and durable sort of rebound in services activity if it's the case that as we move through into the late spring again and into the summer, lower levels of community spread, lower levels of hospitalizations and hopefully fatalities. These are all things that allow a more durable relaxation in social distancing, and restaurants and bars, services, travel, all these types of activities are able to reopen more fully and more durably, and critically, people are more confident using them, because that's the other binding constraint here. That it could have been the case that last summer people could go to restaurants, but they didn't feel confident doing so because they didn't want to put themselves at risk. So I would expect the rebound in spending to be quite robust, and I would expect it to get closer, at least, to that, recovering almost all of that initial rebound, not in one quarter, but over the next few quarters at least. So I think that almost the way to think about it is that was almost a sneak peek of what a fuller recovery might look like, the experience of moving out of lockdown last time round.
Right. And I think the point you made there around people feeling comfortable to go out, because of course we talk about the United States like it's one amorphous country. And, the reality is for other countries, it's easier to talk about things like national restrictions, although there is a lot of regionalization. But the US is like that on steroids, right? Because it's actually 50 states who have taken different approaches. And particularly, I wanted to ask you about, the loosening in restrictions in places like Texas, Mississippi. I think you said to me recently, even Massachusetts is kind of easing in terms of restaurant capacity. I mean, to what extent do you think that there will still be a lag in terms of people feeling comfortable once they finally get vaccinated to go out and do these things? Is that an important threshold, do you think, for people? And is that kind of going to be built into the reaction that we see?
I think the important thing here is that all of this is related exactly to the new cases data and what we're seeing on the ground. So there certainly has been an easing in restrictions. We're seeing that sort of, as you mentioned, not just across some of those states which have been less inclined to implement these sorts of COVID restrictions on activity, but across a broader range of states. And it reflects the progress that has been made in bringing down new cases. I guess the risk is that if you open too quickly, then you could undermine that confidence, particularly if these new strains mean that it doesn't take particularly long for community spread to rebound quite rapidly. So I think should we start to see, that I think that's the major risk almost to that sort of quite rosy picture that I've painted of a vaccination program helping unlock consumer spending with quite strong balance sheets behind it. I think the risk to that would be if you reopen a little bit too early, and certainly the CDC seems nervous about some of the steps that are being taken, particularly around mask mandates, then do you potentially start to undermine public confidence and people look at the case data, look at the hospitalization rates and say, we're not there yet. It might be open, but we're not prepared to do it. Right. So I think it's just critical that those states that are reopening are just very sensitive to what they see on the ground, whether that reopening leads to a rapid resurgence in cases. I think it'd be important to take steps until you've moved further down the path on the vaccine program. So it's really interesting how all that interacts. What you hopefully get to is a point at which, further later in the summer, you've vaccinated enough people that feedback mechanism isn't coming back and damaging confidence, whereby more economic activity leads to a worsening public health outcomes.
No, that makes total sense. I think there's so many factors that go into this in terms of, vaccines and mutations and just people's individual behaviors, which obviously matters quite a lot. Maybe to square off on this segment then is just to ask about the savings effect of all of this. So we've talked about the spending, and the implication is definitely that spending is significantly increased. What does that mean for the flow, but also the stock of savings, of household savings that you mentioned are just so high after this lockdown period? Yeah,
I think that's a great way of coming at it, because exactly if we imagine that out of everyone's monthly income, they spend a certain amount, they save a certain amount. And what our forecast is essentially saying is, as we go forward, they're not going to have to, out of that flow, save as much. They're going to be able to spend. And the personal savings rate at the moment is over 20%. It spiked a little bit because of the latest round of stimulus checks. But normally that would sit, let's say, between 5 and 10%. So what you build in is a normalization that households are saving for precautionary reasons a smaller amount. And that means that they're spending more. But I think it's a really important question. They've been saving quite a lot over many, many months, and that's accrued, and that sits in a few forms. If we try and estimate the total size of that, we're talking well over $1 trillion, maybe 1.3 to 1.5 trillion in accumulated savings over that point. Some of that's sitting in checking accounts. I mentioned about 700 billion there, just in, I guess, relatively accessible and liquid cash. But I think that boost to household wealth holds some really interesting implications for what we might expect from the consumer sector going forward. So from one perspective, it suggests that they may be able and willing to go out and spend more freely. They feel more financially stable. We know that they've used some of this extra firepower to pay down some aspects of debt, particularly around consumer credit. One area that's interesting, though, is that mortgage debt has been increasing through this period. So while they've maybe been cutting credit card spending, for instance, auto spending, or at least paying some of that down, they've been adding to their housing investment, to their mortgage debt. So it suggests that maybe some of this money might find its way into the housing market. And that's certainly something that we've seen and continue to see very high demand for housing in the United States. House prices very high, inventory very, very low at the moment. So I think some of it's being channeled in that direction. More generally, it should suggest, I think, that there's, I guess, less sensitivity to shocks if people feel that they've got a a greater degree of security in their financial position. But one interesting potential risk to the upside is that they just want to spend more of it, that they don't feel that they should be holding as much accrued savings, and rather than using it to pay down debt or just improve their financial position permanently, they decide to reverse some of that saving. And the analogy would be, I didn't go on holiday in 2020, so I'm going to do 2 holidays in 2022, or it's this sort of catch-up spending. So I think that's one thing we're watching for carefully. And it's not just the United States. We see this across many developed markets, that households have a bit of a war chest. I think in general, people expect that just to be added to the household wealth position and not drawn down very significantly. But certainly there is a chance that they want to go out and spend that more aggressively. So I think that's something that economists are watching closely. There's some evidence that following these types of pandemics, households become permanently more cautious. So maybe there's a justification, given that we now know that lockdown is possible. This time last year, we would have been, I think, shocked to have seen this type of event come around. It could be the case that now we know these shocks can come and the impact that they can have, that we want to hold higher levels of saving permanently. But I think the savings question is really difficult to get a strong prediction on, but it's potentially really important for the outlook.
Yeah, gosh, I mean, everything you've just said kind of highlights, you can make arguments for why they, those savings, not only will the savings rates drop, but also actually maybe people eat into their savings to spend because they're just so keen to. Or is there like a behavioral impact whereby people feel this is a real and present danger that can happen to us at any time, and therefore I want to hold more savings? I mean, maybe just to talk about what all of this means then, from kind of the economic perspective at least. If we do see a situation where you have just a permanently higher stock of savings, household savings, I mean, what does that mean for the economy? Maybe first off, we start with what are the potential benefits of that world in which you have households just holding higher stocks of savings?
I think the benefit is that household financial positions are robust and strong. And
right.
We can look back at the last crisis, the great financial crisis, keep coming back to this, but that shows us what can happen when households feel that they've become overextended. The housing market boom and then collapse left households, with levels of debt that they were uncomfortable with the value of the asset that debt was held against was uncertain and had probably fallen. And the effect of that was felt over many, many years when households weren't spending as much. They were trying to save and repair that financial position. So I think one benefit is, with the household balance sheet in aggregate, looking in relatively good shape, is that this crisis probably, we don't have to see that balance sheet repair that we saw after the financial crisis. So I don't think it will be the case that savings rates need to remain very, very high for precautionary reasons or to try and repair some of the damage done through that. So I think that's a benefit. It means that we should be more resilient to potential shocks down the line, as households should feel less sensitive about their financial position. So I think that helps.
Yeah, for sure. And then maybe on the slightly more negative side, are there any drawbacks to having structurally higher savings rates for households?
Yeah, I mean, one drawback would be, I suppose, that this is just a structural change whereby households, as you mentioned, are more just risk averse through this period, and you don't really feel the benefit more broadly because they're just more worried about the outlook. They think, when will the next pandemic hit, or when will another major shock hit, and so their willingness to go out and spend just is permanently limited. And our expectation that a reopening in the economy leads to much less forced saving is too optimistic. And actually, they want to save more, and more of that is precautionary saving than we're currently factoring in. So, I think it's that. I think you summed it up really well. It's that just trying to understand that behavioral factor is really challenging across households. But there's a bit of a risk that this sticks around more, and households, it's 3/4 of overall demand. So if it's the case that they're just permanently looking to try and improve their financial position or save against the next type of crisis or shock, then I think that would be a worrying signal.
Yeah, absolutely. So obviously we can't have a conversation about spending and saving after lockdown without mentioning the inflation debate that is obviously raging in markets at the moment. In particular, this question about risks of overheating. To what extent do you think that this individual spending and saving decisions are an important part of this debate? And how do they kind of weigh off against other factors that you're considering when you forecast both growth and inflation?
The household sector, I think, is going to be one which people are concerned about the degree of spending over coming months. I think it's absolutely the case that as you get some reopening, we're already seeing signs of this from the early 2021 spending data. As you get some gradual reopening of the economy, and as stimulus checks are landing in people's bank accounts, as unemployment insurance benefits are topped up, new child tax credits, the whole range of the interaction of this fiscal support and a reopening economy and relatively high existing savings rates, I think that's going to lead to very, very strong consumer spending. And that's clearly going to spook some people. There are concerns that growth rates of 10% annualized over Q2 are too fast for the United States, that the economy is effectively overheating. And, as everyone is going out and trying to spend, be it on goods or be it on booking holidays or be it on, even going to a local bar and restaurant, that's going to push up inflation for those components. And we're going to start to see the economy overheating, and that would be damaging for the cycle. So I think that's where it fits in. We're more sanguine, I think, on the ability of the economy to withstand, I think, that strong growth without developing those overheating symptoms. But definitely, I think people will look at household balance sheets, look at income support, and then see, as the economy starts to reopen, very, very strong growth as a sign that this is too much. So I think that's where the debate is sort of centered on at the moment.
Right. I think it just underscores what a difficult job you have at the moment, trying to forecast, not only the economic outlook, but also crucially the inflation outlook in a world where there are so many known unknowns, and there are so many factors that are likely to affect what is really individual decision making in a way that, economists just really haven't had to deal with in many, many decades. I mean, arguably since the Spanish flu, in terms of the type of global shock that we're facing, particularly for the United States.
That's absolutely right. And the difficulty, we always say, this is a new type of crisis. We know with 10 years plus hindsight, we know what the financial crisis looked like and the recovery from that. This is naturally a different type of crisis, and we have a totally different type of policy response to it.
Right.
We have coordinated, aggressive fiscal and monetary support, which is what myself and many parts of the economic community has prescribed at the moment in this environment. So, I think it's reasonable to sort of say, what if this time is different? I think where we keep coming back to is, it's been really hard to get inflation over a long period of time now. I think the evidence is quite compelling that you can push economies pretty hard without really starting to see those threatening and aggressive increases in the wage sort of price dynamic in the economy. We know as well there are a bunch of global disinflationary forces that we were all talking about 18 months ago, but just haven't gone away either. Mm-hmm. So I think that's what makes us believe that the most likely outcome is that the economy can run hotter, can absolutely enjoy this stronger growth without threatening a major outbreak in inflation. But that is based on many assumptions, and one of those is exactly what households do with their accrued saving, how aggressively they go out and spend it, and how that demand permeates through the economy.
Yeah, absolutely. And I cannot let this episode end without asking you, as an individual, your individual behaviour. What is the first thing that you want to do when things reopen and you can go back into the world? Yeah,
so you mentioned earlier that I'm based in the United States, so I've not managed to get home. You probably can tell from my accent that my home is not in the United States, so I've not been home and seen family in around 18 months now. So I'm I'm certainly looking forward to getting back to the UK and seeing friends and family. And if I'm really honest, getting to an Everton game at Goodison Park is, I have to say, the friends and family stuff, but also the football.
Well, you kind of stole mine, because I have to say, as is obvious as well, so I'm based in Scotland, but very audibly Irish. And again, it's the same thing. I think as soon as possible, just getting back, which maybe we're an indicator about, prospects for global travel, although we do think global travel will just take a while to kick back in. But just in the interest of alternative answers, so we don't have the exact same one, I'm also really looking forward to someone else pouring my wine and someone doing the dishes. That is not me.
Yeah.
And not my husband. So maybe that gives a sense of the kinds of things that, at least, earlier we heard from the rest of the Macro Matters team, their priorities. You've got our priorities, a tiny little sample, but I guess the big question is going to be how the wider economy and how different economies adapt going forward, and how those individual behavioural decisions that each household makes builds up into, the overall economic environment we find ourselves in later in the year. So unfortunately, that's all the time we have for today, but thank you so much, James, for coming on again. Thanks to all our listeners for tuning in. Once again, we've been really overwhelmed by how much support the podcast has gotten. If you've got any questions or any ideas for topics that you'd like us to tackle, or any feedback on this episode, you can email us, macromatters@aberdeenstandard.com. And next week, we'll be back talking about cryptocurrencies, so please do join us then.
Please note that email is not a secure form of communication, so don't send any personal or sensitive information. This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen Standard Investments. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns. Return projections are estimates and provide no guarantee of future results.